Good afternoon, traders. This is Paul and Michael coming to you from Game Edge on Sunday, May 1st. Today we're going to do a webinar education session on a topic that has been coming up in the Discord room often within the past few weeks. Go ahead and check us out on Gamma Edges at Twitter at Gamma Edges, and the YouTube link is there. Go ahead and click on that and like and subscribe for us. If you'd pause your video player here and read this for us, this is just a general disclaimer. It's important to us, so it should be important to you. And then go ahead and hit your play button after this, and we'll continue with the webinar. All right, today's focus for the session is going to be different methodologies associated with the expected move. A few traders in the room have been asking and inquiring about how not to choke a trade off. Also, we've been discussing how to pick a method that suits your risk tolerance and personality. We're going to go over calculating position size using an index ETF via SPY. And also, we're going to give an example on how to calculate position size using a leveraged ETF SDS. All right, Paul, go ahead and take it away, and you're going to explain the expected move methodologies for us.
Sure. So we're going to present four different expected move methodologies. There are various ways of doing this. The industry does it various ways. The first one is what we call an option at the money approach. And basically what this is doing is it takes in this case, the SPY, which closed at 413 and change on 429. And we take the midpoints of those. We basically add those together, and you get the one-day expected move. And so when you take that, you get an overall percentage of what the overall expected move for the SPY is, just using these. Generally, it works pretty well. Just keep this in mind as we go to the next one. Method two, many of the brokerage platforms that you're utilizing use both or present the dollar amounts that are available as a function of the expiry. So for each of the expiries that occur within the overall chain, you'll get a dollar value. And in this particular case, 714, again, divided into that at the money, 413 gives you 1.73. And you can see that they're fairly close. They're fairly consistent. Option three is the one I actually prefer when I use these methods. This one actually takes what's called the implied volatility of the actual option at the money option in this particular case. And you can see on the call side here, it's at 45. On the put side here, it's at 31. And what you end up doing here is averaging these. So you take these, divide them by 2, and you get a 38%. Now, implied volatilities in your option tables are annualized. And so what you need to do is figure out what it is on a day over day. There's 252 trading days in a year. So when you take that number, you take the square root of this for reasons that we won't go into, you end up with this math. And before you know it, you get this 2.42% is your expected move. And if you recall, this is a little different than what we saw here. Shows you a little bit broader range. And so when you take that into that 413 again, you get a $10 range. And this is saying that you have an expectation of moving at least $10 up or down in either direction on the SPY in any one given day. It's important to note that the three methods have some boring math. Again, we won't go into it. That suggests that the price should be within this plus minus range only 68% of the time, which means 32% of the time it could be outside of these ranges. And so what we do see is a lot of folks will double these values. And when they do that, it puts them up into being within that range 95% of the time, which is considered 2 standard deviations, or 19 out of 20 times, or 1 day out of a month, you would violate that on average. So keep that in mind. We'll actually employ this as we go forward. A fourth method here, the final method, is to use something called the average true range. And for you math geeks, I've gone ahead and just thrown all the math over here. Basically, it takes the high of the day, low of the day, and the previous day close, and then it takes the maximum of the set of the three that you see here, averages them, and then it comes up with a number. And our recommendation for everyone here is use a pre-calculated indicator or a study from your brokerage platform. Both TradeStation and TOS have this built in, so you should be able to look at that and have that automatically calculated. We use a 14-day, and we think it's a fairly good approach when we do this. And you can see in this particular case, for this exact same indications that we did, or these four methods, we get 2.28 here, which is consistent with a more conservative approach. So I'm going to go ahead and pass it over to you, Mike, and for the wrap up and carry on.
All right, thanks for those explanations there on those methodologies. So here at Game Edge, we're just laying out the option or the methodologies that Paul just went over, and we've highlighted the method 3 and method 4 that we kind of suggest traders to use. Obviously, we see method 3 is the most conservative at 2.42%, but then ATR is comes in very well at 2.28% and a conservative. I'll be honest, since I'm an ease of keep it simple person on my trading, I use ATR. It's just easier calculation for me. It's readily available, and you can do the math fairly quickly for me. So anyway, takeaway for this slide is remember to be even more conservative. You can double those values, as Paul said, and then for 90% of the time, you'll be within those 2 standard deviations. This also kind of leads to not getting stopped out as much, but this also leads us further on in this presentation where you want to make sure that you continue to manage risk. All right, so here's our exposure example using the SPY. So our portfolio equity is $10,000. Your risk amount is 0.5%, and here at Game Edge, we kind of employ or encourage new traders or investors to use this 0.5% methodology. This will allow you to be in multiple trades, even if you're wrong or if you're just learning how to trade, and really not cause a significant drawdown in your portfolio. And you can have multiple losses and still be able to recover from these losses. So you see that's a 0.5%, so it's a $50 risk. So our expected move, we're using the most conservative method, which is method 3 on the option IV. So we selected the SPY strike at 413, the 1-day expiry DTE, and that shows us that our implied volatility is 2.42 and $10 daily expected move in dollars there. So our allowable stop position exposure for the SPY on our 0.5% risk, we calculate the 2.42, which is $10 a share, and our exposure is $50 risk. So we can have a maximum of 5 shares of the SPY. It doesn't seem like a large position, but if we've calculated our risk correctly, then that truly is the position. And you can see the exposure with the stop there is 49.97. So remember that 68% chance that you stay within those 2 standard deviations, or sorry, 1 standard deviation and the daily range of 2.42% there. So doing that 95%, that which would be the 2 standard deviations, and using the more conservative, 19 out of 20 times you would stay within those bounds and those ranges. If we do this 95% by doubling those values that we spoke about earlier, then that leads you to only have 2 or 3 shares total position, and then you place your stop at 4.84%, which is the double of the initial calculation, and that would be $20 per share, which actually is a larger stop, but we have to remember that 95%, 19 out of 20 times, you will not get, your stop will not be hit. So the criticisms that we hear from multiple traders and new traders within the Discord room is 2 or 3 down days in a row could have you hitting your stops. Absolutely, that is correct. Either you've chosen the wrong entry point, or you could be on the wrong side of the market. But either way, we've managed our risk and we've stopped out our position, which is going to happen to all traders. Doesn't matter your skill level. It's just a fact of what we're doing here as being a product of trading. It's our next criticism here is virtually impossible to get ahead with only 2-3 shares of SPY in the account. And I think this is one that Paul and I both love to debunk, which is incorrect. It does not matter if you have 2 or 3 shares of SPY or 200 or 300 shares of a low-cost stock, provided that your risk profile is the same. And I think that's a key important fact for new traders to understand. Many traders get overexposed very quickly and then have a larger drawdown than what they anticipated. The last criticism here is 0.5% exposure per position is too conservative for a risk value. I'm comfortable doing what IBD suggests and doing 4 to 5 positions. So for a $10,000 account, this would be $2,000 to $2,500 per position. Well, coming from an IBD background, which it seems that many traders in our Discord room are also, this is incorrect because IBD does recommend 4 to 5 positions for a smaller portfolio, but they also suggest cutting max losses at 8%. 8% of the $2,000 is a risk exposure of $160. So we're really not too far from what we have demonstrated here. I think the other key component of that is when IBD suggests your buy point, it's no more or no greater than 2 to 3% above the pivot. So if you're buying correctly, which we've already discussed, then your risk of getting stopped out should be a lot less also. The other last criticism we hear is, doesn't using options eliminate some of the risk? I should be able to buy a long call or long put and limit my risk up front, right? Yes, you can limit your risk using options, but you also decrease your chance of success because you're limited in the size of your contract that you can buy given your portfolio exposure considerations. So at here at Game Edge, we've been discussing using options long naked and the reasons why it takes a greater screen time and more of your day to manage these. And I think that's why we're trying to explain how you can use these leverage ETFs as a different vehicle. A firm understanding of the option parameters, including days to expiration, probability of profit, and option Greeks, specifically delta, theta, and vega, are required if you are to properly use options to grow your portfolio. I would have highlighted this probably in huge bold letters. A lot of new traders come in and want to trade options, but they truly don't understand any of the option Greeks or any of the underlyings, and specifically zero DTE options are a different animal altogether. So, and how to simultaneously manage your risk. So the use of stops is more difficult with options, which we've heard multiple times in the Discord over the past probably 2 to 3 weeks, and I'm sure Paul's inbox has been filled with questions about this. Price changes of the underlying impact delta, change in option price differently depending on DT and other options Greeks, which we've already explained. This interplay is complex and you need to have a sense of each of the components to properly manage. That is a key statement there. And it is not impossible to use stops with options, of course, but it is a more advanced topic and beyond today's discussion. I think that we've had an ongoing discussion in the Discord room about how options move further than the underlying, and that leads to that statement right there. So we're using leverage ETFs in lieu of index ETFs. We like to use leverage ETFs to trade. If you're not an experienced options trader, you can use these to gain leverage to the market just like options. So you can pause here and look through this slide if you want. But basically what we're suggesting here is that you trade a very liquid ETF that has a high open interest and the bid-ask spread is as small and tight as possible. The bid-ask spread may change throughout the day. This was just as of closing that we took the bid-ask spread on this. So our suggestions here at Game Edge are that you trade the 2X ETFs. You can trade the 1X if you like, but the 2X ETFs, I think, allow new traders with a smaller account to have a smaller price and be able to get exposed to the market and have good trading outcomes. So our exposure example here using the 2X Contra ETF using STS here. Now we did use method 3 to calculate this. So you can look through all the calculations here, but we have the same portfolio equity and our risk amount is still $50. And you want to pick a direction on the market model. So our cumulative tick in our market model still is still employed. Nothing really changes with that. We're just using the SDS instead of using directional options naked. The expected move for our most conservative here, method 3, option IB, which we've calculated. So we've calculated all that out. So $50 risk on the 4.33 expected move allows us 11 or 12 shares of SDS, which is definitely doable for traders with a smaller account size. So our exposure example 2 is using ATR, which is the one that I usually prefer to use. Same portfolio equity, same risk amount, same market model structure that we want to follow. And this allows you to have 14 or 15 shares of SDS, and that calculation is shown there. 95th confidence interval gives you 336. So we divide that by the $50 risk. And again, that allows you your position size of 14 to 15 shares, which is definitely doable. The other thing we didn't discuss here is you could have multiple positions in multiple ETFs. If you're trading SPY, Qs, or IWM, we'll be able to show those 2x ETFs also. So you can get a cross exposure to your whole, the whole market if you position size and correctly manage the risk on each of these. So takeaways today: know your expected move, pick a method, and use one that fits your personality. I think this is important, and one thing that I harp to all new traders, and if I'm providing education to any new traders, not one size fits all. Everybody has a different personality, everybody has a different life, so you need to make sure that it fits within your trading plan, your trading style that you've outlined. Options trades may take more screen time than using ETFs so far. So for those that work while trading, leverage ETFs could provide a better alternative to time management. And that's a reason that I use these, and I've explained this in the room, and what we're explaining today is I want to have a life outside of the market a lot of times, and I don't want to be tied to my PC or my computer. So trading these leveraged ETFs allows me to enter these positions, set my stop losses, and then walk away from the computer and maybe just check it into end of day or intraday just a few times. Leverage ETFs provide a good alternative to options, especially for smaller accounts and newer traders where you want a risk management to be primary focus, e.g. capital preservation. I think this is extremely important. You can have a very small risk if you position size correctly, so you can be wrong multiple times. And I think this is important for new traders, that they don't get frustrated and not see their account significantly draw down. You don't want to see a $10,000 account go to $5,000 because you're oversized with options. So if you position these ETFs correctly and you have multiple losses, even 5 or 6 in a row, you're really not taking a huge hit to your overall capital, and it's allowing you to learn how to trade. And then when you start being able to size up, on the risk management and understanding, then those losses will be taken care of by your wins. So market model will be a cumulative tick and gamma levels that are still in full force using leveraged ETFs. This is also an important concept. Paul's morning call goes through the wing charts and the gamma levels, and those all still apply. These are just the underlying that we're looking at, so nothing really changes on that aspect. You still want to be directional with the market, and do not be going against kind of what the gamma levels are saying and what the wing charts are saying. So, okay. Paul, any other additions to that?
No, I think we've got it. Thanks a lot for going through this. For everyone, if this is of more detailed interest to you, please join us at gammaedge.us. That'll take you to a sign-up page that'll get you into the Discord. We've got a 14-day free trial, no risk to you, all the tools turned on, a great group of traders, all experience levels, many with very different portfolio sizes, so you get the best of the best. Very active voice channel. As Mike said at the open, follow us on Twitter at Gamma Edges with an S. And then, of course, you're watching this off YouTube. If you like today's content, hit that like button. We appreciate it. And, of course, subscribe to the channel if you're not. And that way you'll get notified next time Mike and I do something here. So with that, we will leave you and hope to see you in the Discord. Thank you.